Welcome members to the Study Circle program. I am President Floral Bouquet to speak. It's my privilege to introduce the speaker of the session. Srinivasa Tikkisetty is an Associate Director with Deloitte India Global Business Tax Practice based in Bangalore for 6+ years. His areas of extensive experience include tax advisory on corporate restructuring and other complex direct tax issues apart from routine direct tax issues with tax litigations, tax compliances, international tax advisories, etc. He is a member of the Institute of Chartered Accountants of India and a graduate of Bachelor of Commerce. He is also a qualified cost and management accountant. He has written articles in Tax Journal and has contributed to thought paper and policy related matters. With this brief introduction, I open the floor to the speaker. Yes,
Thank you, Pramod. Thank you. So, without further delay, today we are going to discuss on the topic income competition and disclosure standards (ICDS). That is the mainly we are discussing about the practical insights on the disclosures. So, any amendment or any new concept that is being introduced in the Act, we always look for the reason and what is the rationale for introduction of the particular amendment or the new concept into the Act. So, if you look at what is the rationale for introduction of this ICDS, so when we see the accounting standards, like the books of accounts, the financial statements will be based on the presentation of based on the accounting standards. So when we look at the evaluation of the accounting standards, initially we have the accounting standards IGAP, and later on in 2015 the ICDS has been notified. So Indian accounting standards. Thereby there are a lot of adjustments that has been taken place in the books of accounts. So it's been really difficult for the tax officers to track those adjustments and see what is the impact on the computation of income. So that is one of the reasons for the introduction of this ICDS, and that's the reason. And the other thing will be like different SSCs will be following the different set of the accounting standards. One is the IGAP, that is the normal accounting standards. The other one is the ICDS. So for each set of the standards, there will be different adjustments that will be taken, that will be carried out in the books of accounts, and whether it is a revenue recognition or the provisions, that it depends on each set of standards that SEC follows. So that's the reason ICDS has been introduced to bring the uniformity and to the computation of the purpose. And if you look at the history, whether are there any standards that has been notified previously in the Income Tax Act. So it's the ICDS has been enabled in the section 145. If you look at the section 145 that is there in the pre-1995. So it allows the three methods of the accounting. One is the cash basis of accounting, accrual basis of accounting, mercantile basis of accounting. The other one is the hybrid system of the accounting. So when the hybrid system of accounting does, there were some loopholes. Like if there is a receipt, if there is an advance that is received from the particular vendor, I can choose for a particular source of income for that vendor. I can tax it on accrual basis, because that will help me to pay mitigate my tax liability. And in case of there is a vendor, the receipts are less, whereas the accrual of the income is more. Those cases I can for that vendor I can choose the receipt basis. So thereby there is a loopholes is there in the hybrid system of the accounting. In the 1995 Finance Act 1995 has substituted the section 145 with effect from the 1997 to 1998, and wherein this hybrid system of accounting was removed, and only the cash basis and mercantile system of accounting was there. So, and that point of time, there were two standards that has been notified. So, one is the disclosure of the accounting policies, the other one is the events that are occurring after the balance sheet date, and private expenses and the private incomes. These are the two standards that has been notified at that point of time, but really it was not operational, those standards. So, then again, coming to the 2002, wherein there is a committee that has been set up to see the study the standards and provide any recommendations. Even after that, nothing was materialized. And in the 2010, where there was a discussions around implementation of the ICDS, the IFRS convergence standards. So at that point of time, again the one more committee has been set up. So in 2013, the company has come up with the recommendations. So the committee has said that in case of the tax accounting standards has to be formulated so that it will bring a clarity or a certainty when it comes to the computation of the income. And if there are any like two alternatives, like there are judgments wherein it says one view and the other judgment gives a contrary view. So it gives an alternatives to the taxpayer. To eliminate those taxpayers, so to eliminate those alternatives, this tax accounting standards can be brought in. And in case whatever the tax accounting standards, like differences between the tax accounting standards and the books that has been maintained or the financial statement that has been prepared either on the IGAP or the ICDS, whatever the differences are there, the committee said that there has to be a reconciliation that has to be presented. So these are the recommendations that the committee has given, and based on that, this ICDS has been notified. So if you look at the section 145, that's what the new amended section, it says use only two methods of accounting. One is the cash basis and the mercantile system of the accounting. So initially the ICDS has been notified in the 2015, that was March 2015, and made applicable for the AY 1516. But since there was a lot of debates when the initially ICDS was introduced, stating that these are contrary to the Act, certain provisions in the contrary to the Act, and even the ITR and the Form 3CD has not been amended to make the respect to disclosures. That's the reason they have postponed that applicability to the AY 1780, and they made some amendments in the ICDS also. The revised ICDS they have notified in the September 2016 and made it applicable from the AY 1780 onwards. So, and one more important thing when it comes to the section 145, subsection 3, it gives the powers to the AO to make the best judgment assessment. So, in case in the books of accounts, if the AO has doubt on the correctness of the books of accounts, then he can do the best judgment assessment after giving an opportunity of being called to the SC. And when the ICDS was also introduced, they have made an amendment to that also. They said even case where the computation is not prepared in accordance with the ICDS, in those cases also they can do the best assessment. So if you look at what are the ICDS that has been notified, there are 10 ICDS that have been notified. That is accounting towards to the provisions and contingent liabilities. And there were certain 3 ICDS, like ICDS on the leases and the intangible assets. Those were released for the public comments, even on the ICDS on the real estate developers were released for the public comments, but however it has been not notified yet. If you look at the applicability, to whom it is applicable, what set of SSC it is applicable. So ICDS is applicable mainly to the SSCs who are following the mercantile system of the accounting, and not the SSCs who are following the cash basis of the accounting. And so because these are mainly the accounting standards what we follow in the books is mainly for the purpose of the business income. Okay, so that's the reason, and the other income like interest or royalty, mainly those, that's what the accounting standards or the ICDS really discusses. That's the reason they made it applicable only to the 2 heads of the income. One is the BGBP and the other one is the income from other sources. And it is not applicable to the other heads of the income. And it's been clearly called out in the preamble of the ICDS that this ICDS is only for the purpose of the computation of income. It's not for the maintenance of the books of accounts. So books of accounts has to be maintained based on the normal IGAP or the ICDS. So when it comes to ICDS, it's only applicable for the computation of the income. So they given a relaxation to the small taxpayers, that the individuals and HUF who are not subjected to the tax audit. So they are given an exemption from the applicability of the ICDS. So when it comes to the present to taxation, so the question is whether ICDS is applicable or not. So for this, they have given a clarification through FAQs. So where they said that when we look at the present to taxation, we have to determine the gross receipts, on which we will apply the 8% or the 50% profit rate prescribed by the Act. So for determining the gross receipts, we have to follow the ICDS. So that's what the clarification has been provided. And if you look at the whatever regulated sectors like insurance, other banks, financial institutions, whether this ICDS is applicable or not. So it's not applicable because there are separate provisions the Act, if you look at the insurance, there is a Schedule 1 in the Income Tax Act, which prescribes the separate computation rules for determining the income for the insurance business and all. So those sectors have been excluded from the applicability of the ICDS. And coming to the if you look at whether the rules act, when there is any contrary between the ICDS and the Act or rules, which will prevail. So it has been clearly, when it comes to Act, it has been clearly spelled out in the standard that the Act will prevail over the ICDS. And when income tax rules, it's silent in the ICDS, but since the rules, but there is a clarification that is given for the rules when it comes to income tax rules or ICDS. If ICDS is contrary to the rules, then there is a clarification that has been given. They said ICDS is for general computation of the income, whereas rules are for the specific set of specific thing. So they said that rules will prevail over the ICDS. And even the circulars or press releases, if there is a circular or press release prior to the introduction of the ICDS, then they said that ICDS will prevail over those circulars or press releases, because ICDS has been notified after considering those circulars and press releases. If there is any circular or press release that has been given after the enactment of this ICDS, they said that then we have to see that, because when it comes to circulars, press releases, it's only binding on the tax officers, it's not on the SSCs. If it is a beneficial circular, then SC will take the benefit of the circular. If it is not, then always SC has an option to not to take the not to abide by the circular. Now the question to the audience is, the ICDS is applicable to the non-residents.
Provided if they have PGPP income and other income, or applicable.
Yes. Yes. Yeah, you're right. It's applicable, but there is a condition where when it comes to non-resident, we always, if they have the DRC or the Form 10F, they can take the benefit of the DDA. Okay. In case if the income is subjected to tax as per the provisions of the Act, that is Section 150A and all. So those cases ICDS will apply. Okay, because they are offering to the tax based on the provisions of the Act. In case if they are offering income to the tax based on the DDA, so when it goes to Section 90, it overrides the entire provisions of the Act. So including 145(2) and ICDS also overrides. So thereby, if the non-resident is offering the income to the tax as per the DDA provisions, then this ICDS will not be applicable. Moving on. So the first ICDS is the accounting policies. So if you look at the name of the standard, it says accounting policies, because normally we follow the accounting policies for the purpose of maintenance of the books of accounts. So but here the name of the standard is mentioned as accounting policies. So there is a so in this regard there is a guidance that has been provided in the technical guide, where they said that the accounting policies that they referred is mainly for the purpose of the computation of the income. So thereby they said that this accounting policies, what is stating in the standard, it has to be read as a computation policies, not as accounting policies, because it's mainly for the computation of the income. Yeah, so it's ICDS one. It's more or less similar to the AS1 in the IGAP, or INDES 1 or INDES 8 when it comes to the INDES. So, but if you look at the basic, when you look at the AS1 or the basic fundamental accounting assumptions, we need going concern and consistency and approval. So when it comes to going concern, we always see the business will continue for a foreseeable future. So it's unless we see like some things like there is a default in the debt payments, continuous default in the debt payments, or if there is a adverse key financial ratios and all. So though in those cases, we will note on a going concern. If these are the indicative factors, there could be some other things like insolvency or those things. So those cases, the going concern will prepare the financials based on the realization basis. When it comes to the consistency, accounting policies, whatever the taxpayer or the SC follows, it should be consistent. In case if there is any change, there should be a reasonable cause for that. What is reasonable cause? It's not defined even in the ICDS of the Act. So it has to be taken, the guidance has to be taken from the judicial precedents and all. So generally it will be like there will be a change in the law, or it is driven by the commercial then that can be called as a reasonable cause. And the accrual, so this accrual thing is it's already there in the Act. If you look at the section 5, it's like accrued income, it's already there in the Act. But in the ICDS also it says that revenue and cost can be recorded in the year in which they relate. It's not on the basis of the cash. It is based on the when it is the services are completed or when it is accrued thing. Okay, so it's when it comes to Act, this accrual concept is already embedded in the section 5. So it is already there, and there will be having the precedence of that when the income, when we can call it as income is accrued. Okay, so whether there is a famous Supreme Court judgment in the case of Excel Industries where they said that income has to be a real. Okay, that is one of the tests they said. And the other thing is that there should be a liability for the other party to fulfill the obligation. The other one is there should be a reasonable certainty of the ultimate collection. So these are the three tests that has been specified in the that has been given in the Excel Industries judgment. And when it comes ICDS, if you look at the differences like compared to the accounting standards and India's, what is the main differences if you see? So it's when it comes to ICDS, as I mentioned, it's mainly for the computation of income. So that's why it says true and state of affairs of the income. It's not the true and state of affairs of the balance sheet, the P&L thing. And it also recognizes the concept of the substance over form. ICDS is clearly told it has to be gone by the substance over the legal form. Mainly we have to look at the essence of the transaction. What is the transaction, not by the legal form. And accounting standard also has given three important key considerations like prudence and substance over form and materiality. If you look at prudence and materiality, those things are not there in the ICDS. So prudence, yeah, we discussed, and when it comes to materiality, because even in the Act we know we have to go by very precise on the numbers. When it comes to the computation of income, we cannot really take on the materiality like the 5,000 is not a material, the 1 lakh is not a material based on the company's turnover or whatever. So it has to be very precise. So that's the reason the materiality thing has been omitted in the ICDS. Yeah. So this prudence concept. So whether since the ICDS does not take into consideration the prudence concept, so this has been actually challenged in the Chamber of Tax Consultants case before the Delhi High Court. So because when you look at the section 37, okay, it says that expenditure has been laid out as expended. So it's in the section 37, this prudence concept is already there. Okay, because we have the judgments wherein they said that if there is any provision that I create for the warranty or the sales returns, okay, so that I can take it as a deduction if it is on a scientific basis and there is a proper certainty that there will be outflow of the money. So those cases, so it's already the prudence concept is already in the Act. So ICDS is contrary to the provisions of the Act. So in this regard, the Delhi High Court has held that this ICDS is unconstitutional. So it's not sustainable in the law. To overcome the judgment, so in the Finance Act 2018, they carried out an amendments in the Act. So one thing is with respect to the ICDS one, it clearly says that when it comes to market losses or expected losses, shall not be recognized in the books or shall not be claimed as a deduction unless it is allowed by the other ICDS standards. Okay, so that amendment has been carried out in the Act, wherein the section 36 said that if there is any mark-to-market losses or the expected losses, if it is allowed as per the other ICDS, then the same can be taken as a deduction. In case if the same are not allowed by the ICDS, then it cannot be taken as a deduction. That's about ICDS one. When it comes to the disclosures, so all significant accounting policies has to be adopted by the company shall be disclosed. Generally, when we see most of the tax audit cases, so a few tax auditors will take a stand that whatever the accounting policies that has been disclosed in the financial statement, they just refer to that. Okay, but there will be some deviations, of course. So by referring to that, there will be always some kind of exposure that if the tomorrow tax officer sees this whatever the accounting policy, if you are referring to the straight away to the accounting policies in the financial statements. Simple example is the materiality. So in the case of accounting books, if there is an asset is of 5,000 or less, what we do will expense up to the P&L. Whereas when it comes to Income Tax Act, we cannot claim that assets which are of 5,000 value as a deduction. So we have to take it as additions to the fixed assets, and we can take only depreciation when it comes to the income tax. So we cannot straight away refer to those accounting policies in the financials. So it's like we always have to, wherever there are some deviations, we always have to prepare a separate set of computation policies, and the same can be disclosed in the tax audit. We have a clause 13F where we can give the disclosures. So that's the reason here the significant accounting policies meant it's like a computation policies that has to be disclosed in the Form 3CD. Yeah, the other thing is the what we discussed. In case if there is any those such things like whether assets has been written off on account of the materiality, so that we can clearly disclose it. This is the what has been carried out in the books, and this is what the adjustment is done in the computation of the income. And if there is any change in the policy, accounting policies, so then we have that effect has to be disclosed in the clause 13B and clause 13C. So this is the disclosure that I am referring in the clause 13. So 13A talks about the what is the method of accounting that was employed, and if there is any change in the method of accounting, then we have to disclose the effect on that change. And ICDS is starting from the clause 13D, and if there is any differences between the ICDS and the books, and if there is any adjustment that has been carried out in the computation of income, that standard wise, whether it is 1, 2 or 3, that we have to whether the adjustment is increasing the computation of income or decreasing the computation of income, that we have to disclose. And the disclosures, like what policies I have adopted, that I have to disclose in the clause 13. Yes. So the next one is the valuation of the inventories. So this is also similar to the AS2 or the Ind AS 2, but only certain aspects it deviates. So let us look at it. So when it comes to the scope of this standard, so it's applicable to all the inventories or the goods or services that are normally held for the purpose of sale in the ordinary course of the business, and it excludes certain inventories. So for the first one is the work in progress for the construction contracts, because that has been separately dealt by the ICDS 3 construction contracts. So that's the reason this particular inventory is excluded from this ICDS 2, and the work in progress dealt by other ICDS. So as of now, because if any real estate tomorrow the ICDS of real estate developers gets notified, they may be that. That's the thing we may be referring here. And the third one is the securities or debentures, shares or debentures, that's the securities, the financial instruments which are held as a stock in trade. So those, in case, because those are dealt by the ICDS 8 securities. So that's the reason they have kept that thing out of the ICDS 2. And the fourth one is the producer's inventory of livestock or perishable items and all. So to the extent they are measured at net realizable value. Here it's only includes the producers. What about the traders? If the traders are dealing in like purchase and sale of these things, then they are covered under the ICDS 2. And the last one is the dictionary space, where if the use is irregular, okay, it's not a very frequent, so then it will be like the asset, it has to be capitalized, so that has been dealt by the tangible fixed assets. So when it comes to the like how to measure this inventory at all, so the standard clearly says it has to be cost or NRV, whichever is the lower. So what constitutes the cost? So if it is like a purchase, it's like a purchase price plus import duties, duties and taxes, then if any logistics and any other cost that has loading or unloading charges that has been done. And if there is any trade discounts or rewards that has been done, that has to be reduced. So one important thing when it comes to like here, the cost of purchase, the standard says the duties and taxes that has to be included in the cost of the purchase. So if you look at the act also, there is a section 145A where it says that duties and taxes has to be included in the cost of the purchases or the inventory valuation. But when we look at the accounting standards, it says exclusive method of the accounting, whereas here the ICDS the Act talks about the inclusive method of the accounting. So then there is a deviation, like what books, how the books are maintained and what ICDS is calling or the Act is saying. So in this particular thing, if the books, if it is exclusive method of accounting is followed, since the Act and ICDS is there should be inclusive method of the accounting. So the deviation is that. So the deviation has to be reported in the clause 14 of the tax audit. So here generally the deviation, generally the impact will be nil because it's opening stock plus purchases closing stock, sales minus closing stock, the duties, whatever impact will be, generally it will be nil. So that whenever that tax auditor has disclosed that impact in the tax audit, so we should ensure that the same thing gets disclosed in the tax return. Because recently what we have seen in the last year when the CBC gets processing these returns, okay, and in case if the tax auditor has disclosed, made this disclosure, that is increase decrease of this because of the inventory deviation, valuation deviation. So the IT return was not disclosed. So thereby what CBC has done, they have taken only the increase side of the impact and they have raised crores of demand. Okay, so I know it's an unnecessary thing, but just it is better to disclose in the return and try to avoid these unnecessary things.
I have a question.
Yeah.
Right now you said that in accounting policy where disclosure is required. In that inventory accounting policy, do we need to make a change in there because of addition? Because generally inventory is stated excluding input tax and all. So do I need to make a change and then I have to put it somewhere?
In the ICDS 1 you are saying?
Yeah.
So ICDS 1 there the normal, if it is ICDS 2 is there because inventory is covered by here. Okay, so here I have to make certain disclosures here, like what policy, how inventory is measured and all. So I disclose in the ICDS 2. Okay.
For the example you give no fixed assets like less than 5,000 we charge it off. So that way that one materiality. So do I need to change? You said no, you have to change the accounting policy and align with.
So yeah, so when it comes to like whatever the not particularly dealt with other standards, okay. So if there is any like mark-to-market losses and all, if it is not dealt with other standards, those accounting policies I make a disclosure in the ICDS 1 itself. I'll say that this is the policy I have followed, okay, and this is the impact on the computation that have been carried out. Okay, when it comes to if it is separate disclosure of the like inventory or the securities or that, I go to the respective standard and I make, suppose if the input here taxes, because I follow an exclusive method of accounting. So because in the tax audit anyways I have to make the disclosure. So I will say that in the books I have followed this is the kind of the method of accounting, the impact that is there because of the deviation. So that have been disclosed and then given in the table also there itself. Maybe here the entire content we will not be able to put in the online form. What we can do, we can separately enclose an annexure. So wherein we can clearly say that what has been done and what is the impact and what is the net impact because of this deviation.
No, you mean to say we have to quantify the amount, you mean to say?
Yes. And because it's actually required in the tax audit also. If you look at the clause 14, I will show you. So there also it clearly calls out 145 this where whenever there is a deviation, they will say that you have to disclose these things. And similarly, yeah, if it is a service inventory also covered here. If there is a labor or direct cost when it comes to service inventory, because it's only on the personal. So whatever the costs incurred related to the labor and the personal are the overheads that have to be taken into consideration for measuring the inventory. And in case if it is a manufacturing entity, there will be some cost of conversion because once the goods are produced, then we will be incurring some overheads. There will be fixed overheads and the variable overheads. When it comes to fixed overheads, it will be allocated based on the normal capacity. And the other cost, if we have to bring that inventory to the sales depot or if any logistics has been incurred, those costs also we have to include it in the cost base. And certain there is any abnormal cost or the selling or administrative overheads, those cannot be included because those are not related to bring the inventory to the sale condition. And what is the NRV? It's like the estimated selling price that we like what is the sales price what we have minus the estimated cost of the completion and the selling overheads, whatever the cost that has to be incurred. And in case when we are producing these goods, if there is any byproducts that comes into the picture, so then if there is a byproducts, we can clearly identify what is the byproduct. Then we have to divide the cost on a rational basis. What is rational basis is not been described in the ICDS. So it's something in the judgment report we have to take based on the nature of the business that the SSC is carrying out, or if there is any guidance under the precedents that we have to take into consideration. And if there is any byproduct that is very immaterial, it's not that material, and those cases that has to be recognized with the NRV, and that NRV of those byproducts has to be reduced from the cost of the main product. So when it comes to like how to determine the cost of the inventory, So there have been two ways. One is like when the inventory item when it's not interchangeable. It's like paintings and all. It's like very specific, unique, because each painting I'll be getting a one separate set of the cost. So that those things we have to go by the item, like whatever the cost we discussed in the earlier slide. Based on that we have to determine what is the cost of the inventory. And when it comes to normal items, when the items are interchangeable, so ICDS has given the two methods, and the retail method will be in very unique cases. So it's like a first in first out method or the weighted average cost method. So one of them can be used. And when it comes to retail method, where the value of the same price of the inventory, when it is frequently changing very frequently and fluctuating very frequently, so those cases we can take the retail method. And when it comes to the measurement of cost, they said when even the cost of the materials or the anything can be measured at the standard cost if the standard cost is close to the actual cost. Generally, if you look at the manufacturing industries, the large entities and all, they follow in the ERPs and all, they follow the standard cost, and they do the variances thing to adjust that to so that it will come to the actual cost. So accordingly, we have to determine the cost, and we have to see whichever is lower, and that's where the inventory will be. If any deviation is there, then we can recognize in the P&L account. So if you look at what are the main key differences here when it comes to the scope, so accounting standards it says that it doesn't provide any exemption for the commodity traders, whereas in the ICDS it says the commodity traders like securities which are highly stock in trade, that will be dealt by the other standard, that's why it is excluded. So one thing in the special case, the ICDS, like when the partnership form is dissolved. Okay, so in the ICDS it has been mentioned that the inventory that is there, when the form gets dissolved, it has to be valued at NRV, irrespective of whether the business is taken over by the other partners or not. So if you look at the judgment Supreme Court in the case of Tikkisetty, wherein the facts are that the partnership firm was dissolved, whereas the business of the firm is not is taken over by the other partners. In that case, the Supreme Court told it has to be valued at a cost or NRV, whichever is lower. And when there is another set of facts where the business is dissolved, but the business is not taken over, business is also discontinued along with the partnership firm. In that case, the Supreme Court held that it has to be at NRV. Okay, so there are two different set of facts the Supreme Court has held in the different ways of valuing the inventory. So this has been challenged in before the Delhi High Court. They said that it is contrary. So only the delegation power has been given to the CBDT to notify the accounting standards. It cannot go beyond what is contrary to the law of land. So thereby, to overcome that High Court judgment, they made amendments in the Act. There is a section 145A, where they said that the inventory can be valued at lower of the cost or NRV in accordance with the ICDS. So that thing they had been acted. So to negate that judgment. And also they said that the duties and taxes and the data valuation has to be included valuing the inventory. So coming to the disclosures, so that's what here it's what are the accounting policies that has been adopted. So in measuring the valuation of the inventory, that has to be mentioned. In case if the standard costing method has been used, so that has to be clearly called out that standard costing method has been used because it is approximate to the actual cost. And what is the total carrying amount of the inventories and its classification. So this disclosure, if we can make it the cost, like we have to put it the category wise. What are the inventories and what is the value? Okay, so this disclosure can be made in the clause 39F. So this is the clause 14A disclosure that I am discussing the deviation. So when it comes to the inventory, so what is the because when I am not included the taxes, what is the impact? So those taxes duties I have to disclose here. There is opening stock or closing stock, sales, everything. So generally it will be the impact will be. So the next standard is the construction contracts, ICDS 3. So here, actually the little history to it. It's there is a Delhi High Court judgment wherein they said that the profits can be, when it comes to the construction contracts, can be for the tax in the year in which the amount is received. Okay, so it's and the earlier AS it says that it has to be disclosed based on the completed contract method. Then later on the AS has been revised where they said that it has to be based on the percentage of the completion method. But when it comes to the tax, always there is that issue. Okay, so whether it has to be on the completed contract method or percentage of completion method, that issue is still there because there is no guidance in the Act. Okay, so to negate all these alternatives, this ICDS has been prescribed. So it mainly deals with the construction contract in the case of a contractor. So only in the case of contractor, it is not applicable to the real estate developers and all, because there is a separate standard for that which is not notified yet. So if you look at what is construction contracts, it's like if it is for the constructing an asset or a group of assets. It can be a building or a plant or machinery. If there is a contract that has been taken to construct those plant or building, it falls under this construction contract definition. And along with that, they said that in case if there is any service, like there will be architects, so that their services also will be there. So those contracts also are covered here. And in case if there is any building that has to be demolished or anything has to be demolished or restored, if any water is contaminated, that has to be restored as an environmental loss and all. So those contracts are also covered in the this construction contracts. And when it comes to the revenue and cost, how it has to be recognized or offered to the tax. So it says that the cost and revenue has to be based on proportional to the stage of completion of the contract. It's like based on the percentage of the completion of the method. So how we can determine the stage of the completion? What is the stage of completion of the contract? So there are given the 3 ways which we can determine what is the percentage of the completion of the contract. So one is based on the cost. I have estimated total cost of 100 crores. Okay, and so far I incurred 40 crores of the cost. So that way it's like 40% of the contract has been completed. This is one of the way they have said. Mentioned. Other one is the survey. So we can give it to the third party survey. So wherein they will do the survey of the that particular contract and say that this is the percentage of the contract that has been completed. The other thing is the completion of the physical proportion of the work. If there are 10 floors that I am building in a building, so if the 5 floors has been completed, it's like 50% of the work is done. So that is the other way we can determine. So these are the 3 ways where we can determine the stage of the completion, and whatever the way we are adapting, that has to be disclosed in the disclosure. And when it comes to the construction contract, there will be normally 2 ways. One will be like a fixed price contract, wherein we agree this particular contract is for so many crores or lakhs. So accordingly, the price will be there. When the other way is right, cost plus contracts. So it's based on the whatever cost plus we will be agreeing a markup on that or a fixed fees. So whatever cost I incurred so far, plus if it is a 20% markup or 10% markup, based on that we will determine the contract revenue. And when it has to be recognized. So the standard says when there is a reasonable assurance of the ultimate collection. Here one thing we have to note that it talks about the ultimate collection, whatever the approval. So when the income, suppose if I receive the advance, can I go ahead and recognize the revenue? So here that's what again we have to see the act when the section 5 approval is there. Again we have to see whether the income is really approved or not. Okay, and whether there is an obligation on the party to make that payment or not. So these conditions we have to see, and then only we can recognize that revenue. And whatever the retention money is, suppose if I have to, there will be some conditions that will be attached if I have to get the retention, because the contract generally they retain some 5% of the amount as a retention money. Once I fulfill those conditions, then only they will pay that money to me. So those cases, but when it comes to the standard, they said that when the contract revenue, when you have to recognize based on the if you determine the stage of completion is 50%, and the contract revenue based on that you have to recognize and offer to the tax. They said that it should be including retention money. Okay, so that's where it is to that extent it is contrary to the act. Okay, so even though they carried out a amendment in the act, because section 5 overrides the other provisions. So then they say we can take a position that in case it is not approved, it's only the amount that has been received. So we can take a view that I can still not required to be offered to the tax. to the contract, what kind of costs I have to consider. So one is the direct cost, that is site labor cost. Those things very direct to the contract. And the other things, what are necessary for the contract, like insurance or in the employees, whoever is there, I have to process their payroll and all. So those costs I have to also take into consideration. If any other cost that has been agreed with the customer in the contract, like administration cost or research cost, those things also can be taken into consideration based on the terms of the contract. When it comes to the borrowing cost, we have to go to the ICDS 9. So whatever ICDS 9 says, we have to go by that. So in case if there is any incidental income, suppose like some equipment I bought to construct a building or a plant. So after once the contract is done, I no more require that equipment. So if I sell that equipment, whatever the proceeds I receive from that sale, that I have to reduce from the cost of this contract. But it's been clearly mentioned that if there is any, like if I invested money somewhere, if I got an interest as an ancillary income, it has been clearly spelled out in the standard, even in the act also, that incidental income in the nature of interest dividend by capital gains should not be adjusted to the cost of the contract. And the other important thing is the anticipated losses. If I am anticipating any losses, the standard said that expected losses cannot be taken as a deduction. So it says only the expected losses. If there is any loss that you are foreseeing that it is definitely going to be incurred, okay, it's more than the probability, more than like 50% are very reasonably certain that you are going to incur those losses. Those losses can be taken into the can be taken as a deduction, okay, based on the precedents and all. It's because it only prohibits the expected losses. So there are certain special cases when it comes to the construction contracts. What about the real estate? So which scenarios where it is applicable to the real estate and all. So if you look at if there is any the building that has been constructed, only the flats has to be sold. Okay, and construction has given to the owner, and then the flats are ready to move in flats. Okay, so in that case, this construction contract ICDS 3 will apply or any other ICDS. So if you look at the builder this thing, the inventory always is like a flats and all. So since it is a ready move in flats and all, so ICDS 4 will apply because that's what talks about the revenue recognition. Because the revenue recognition in respect of the sale of goods or services. So that's the reason in those cases ICDS 4 will apply. When it comes to the if any contract, even if it is even it appears to be real estate thing, but the essence of contract is for the construction of any asset or something. So those cases ICDS 3 will apply. Then it has to be based on the percentage of the completion method. And if there are any own account projects, like suppose I am a builder, I want to do some CSR spend. Okay, I build some houses for the slum. Okay, it is for my own account I am doing. Okay, it's not like as a contractor or something. So those cases are excluded. Those cases this ICDS 3 will not apply. And executing agencies, like I am acting as an only agent for the completing or supervisor for the particular contract. Those cases I will be getting a fixed fees kind of a commission and all. So those cases this ICDS 3 will not apply. If you look at the differences, so even ICDS says it has to be percentage of completion method. Even in the accounting standard also it says it has to be percentage of completion method. India's it has to be based on the performance of the obligations, like when the control has been given and all. Only one difference between the ICDS and the ES, accounting standards. When it is in the early stage of the contract, if you are not able to determine what is the stage of completion based on the three things. So those cases, they said that you have to blindly go by the cost, what you incur. But at the time they have given an upper cut that it should not exceed 25% of the entire contract. The upper limit, when it comes to accounting standard, the upper limit has not been specified. They said you have to go by the cost incurred, whatever cost incurred. Based on that we can recognize. And the another difference is that the probable losses. When it comes to AS, they said that probable losses, when you expect that losses has to be going to be incurred, anticipated losses, you can recognize it immediately. This is the one difference. When it comes to ICDS, we cannot take those losses as a deduction.
I have a question. I think in the initial slide of ICDS, you told that there are several methods to recognize a profit as per consumption, be it tax survey or percentage completion in proportion to cost or something. So there could be instance where the profit would be different in each method. If you choose a tax survey method, it will be a profit would be higher and there would be a different profit in the different method. So in that case, tax officer will always want to select the method which is showing higher profits. Right, so that method, if it is given an option to the assessee, it could always be litigated by the tax authority.
True, they can say that, but that's what because the options they are not clearly mentioned that you have to go by this method. Okay, so whatever is you can reasonably you can determine the stage of completion, you can take that method. Okay, unless the tax officer says okay there is a that method is more reasonable compared to the method what you adopted. Okay, unless he has some that rationale for that. Maybe he can if he without that rationale he cannot really contest the method that has been chosen by the SSE. Even when it comes to the linear valuation also, earlier also we used to face that when we take the DCF method and all, the tax officer says whatever projections you are given is wrong, so you cannot take the DCF method. But the courts always said that SSE has a privilege when the two methods are there, he can choose whatever the method is beneficial to him. So the same can be followed here. Yeah, when it comes to the disclosures, whatever the contracts that has been completed, so what is the revenue that has been offered to the tax that we have to disclose, and what is the method out of the survey or the cost method or the physical proportion of the work, which method has been adopted to determine the stage of the completion that has to be disclosed. When it comes to the contracts that are in progress, it's not completed yet. So those cases, what are the costs that has been incurred till the end of the year, and the profits that has been offered to the recognized to the tax, recognized and offered to the tax, and if any advances are received, what is the amount of the advances received, and the amount of the retentions. If there is any retention money that is involved, what is the quantum of that? So this is the indicative disclosure. So when it comes to the contracts that has been completed, so we have to say that what is the total amount of the contracts cost that has been recognized, and what is the method that has been adopted, and the work in progress. Yeah, we have to disclose all the details. Yeah. So the question to the audience is, what should be the timing of recognition of the retention money? So where the ultimate collection is dependent on the occurrence or non-occurrence of the events. There are some conditions attached to the retention money. So when we should recognize that retention money? So when we look at the standard, it clearly says, or the amendment that is taken place in the Act, it says that the contract revenue that we recognize or offer to the tax based on the stage of completion, so it has to be including retention money. So irrespective of whether conditions are fulfilled or not, you have to offer to the tax. But however, if you look at the accruals test that has been there in the section 5 charging section, so it always says that when the income is accrued really and when there is an obligation on the other party to settle that obligation, and those cases only we can offer it to the tax. So thereby even if there is a retention, even if the ICDS and the section 43 CB it says it has to be including retention money, we can take a view that as long as it is not approved as per the section 5, we can take a view that since it is not approved as per the Act, we should not be required to offer that retention money to the tax. So the next standard is the revenue recognition. So it's primarily deals with what is the point of time, like when I have to recognize the revenue, and and also what is how I should measure the revenue. So this what this standard deals with. So if you look at the scope, what covers this standard. So one is the revenue that arises from the sale of goods, the rendering of the services, and the other one is the interest, dividend, royalty. So when it comes to the sale of goods, it says the revenue can be recognized only when there is a transfer of title in the goods and transfer of significant risk and rewards, and there is a reasonable certainty about the ultimate collection. And the rendering of services, it says again percentage of completion is similar to the construction contracts, SCM 3. And when it comes to the interest or dividend royalty, is also the different ways that has to be recognized. One is the interest, it has to be on a time proportionate basis, and the dividend, they said that it has to go by the provisions of the act, and the royalty has to be approved based on the terms of the agreement. Yeah, sale of goods. Yeah, so the conditions, whatever we discussed, like the 3 conditions: one, the title and the goods has to be transferred, and the significant risk and rewards has to be transferred. If any events doesn't happen, okay, then we can postpone the revenue recognition. And also in the case of any like price escalations, or if there is an export incentives and all, so the ICDS says it has to be recognized in the year when there is a reasonable certainty of its ultimate collection. It's mainly going with the collection. So again, what we discussed with the retention money, we cannot directly go by the receipt of the money or the collection. Because of this reasonable certainty of ultimate collection is one of the tests when it comes to the section 5. There are other 2 tests, whether the income is accrued really or not, and whether there is an obligation on the other party to fulfill this. So here also again, because to that extent it is contrary to the judgments. So that's the reason they have been made an amendment in the Act, in the section 195 or 145B, to state that it has to be recognized in the year in which there is a reasonable certainty. Always we can take the other view also, that when it is not really approved. When it comes to the services, it will be based on the percentage of the completion method. And here there are some certain peculiar cases if the contract is only for the not more than 90 days. Okay, so those contracts, they said that when the contract is completed or substantially completed. Substantially completed, again, it's not dependent on the ICDS or the Act. It can be 95% to 99% of the judgment we have to take. And only though that point of time we can recognize the revenue for these contracts. When it comes to like if there is any like other set of contracts where the number of acts will be frequent, very frequent. If you take an example of AMC and all, it will be for a certain period, like a 1 year or 2 years and all. So in though that period, if any there is any glitches in the software or if there is any defects that has to be rectified, whatever the number of defects, they have to do it within that period. So those cases, they said that it has to be on a straight line basis. So it's like if it is for 2 years the contract and this particular financial year only the 5 months has been completed, then proportionately we have to recognize the. And yeah, so when it comes to the interest, so it says that we have to go by the time proportionate basis. Okay, so even if there is no whether I ultimately I'll receive that money or interest I'll receive or not, I have to go by the time proportionate basis. In case if there is any default, debtor makes any borrower makes any default. So in that cases, what is the recourse I have? So in the Act, they made an amendment in the 3617. There is the mandates section. So they said that in case if there is any write-off of the amount as per which is offered to the tax as per the ICDS, that also can be taken as a deduction. When it comes to interest, we need not to go into that thing also, because when it comes to interest, in the books also we will be recognizing it on a time proportionate basis. So thereby there will be a write-off that will be carried out in the books. So when there is a write-off in the books of accounts and the previously is offered to the tax, then we can directly take a deduction of 3617. And when it comes to the banks and financials, we look at the non-performing assets. So there is a separate guidelines that RBI issues. So generally in those assets, if there is an interest, they will go by the receipt basis. Okay, so that's what section 43D talks about. In that case, since the ICDS is saying one thing, it has to be on proportionate basis, whereas Act says it has to be on the receipt basis in case of the non-performing assets and all. So then we have, since there is a conflict between the Act and the ICDS, we have to go by the Act. So those cases we will be recognizing interest based on the Act. And when it comes to income tax refund, the ICDS itself is clearly mentioned that it has to be go by the unreceipt basis when it is the interest on refund is received. And when it comes to the dividends, yes, it's ICDS stated that it has to go by the provisions of the Act. So in the Act we have like 2 types of dividends. One is normal dividend that will be declared interim or the annual dividend, and the other thing is the section 220 or 222. So those where we have various various events or the transactions that will trigger the dividend implications. So they said we have to go by those provisions, section 222, whatever they say, whether it has to be distribution of the profits or there is a reduction in the share capital, and in case if there is accumulated profits, then that also will be deemed as a dividend. And the royalty, again, in case of non-resident, same thing what we discussed whether ICDS is applicable to non-residents or not. So here also the same SLA works. So in case if the royalty is offered to the tax based on the provisions of the Act, then this ICDS will not apply. Sorry, ICDS will apply. In case if the royalty is offered to the tax based on the DTA provisions, then ICDS will not apply for those. So we have put out a reconciliation statement. So when it comes to the AS, so because the dividend result it has to be go by the Act. Because there is a 222 dividend and all, that separately we have to, because those dividends will not be captured in the financials. So we have to separately offer the tax. And the amount not recognized in the current year as because if I am following the, when it comes to the ICDS, I have to be following the percentage of the completion method. Whereas in the AS, okay, if I am adapting a different method and all. So if there is any difference on account of that, because if there is under-reporting of the income in the AS, so that differential amount I have to add it to the tax. And when it comes to interest on income tax refund, it will go by the receipt basis when it comes to the ICDS. In case if there is an interest that is accrued last year, but it is received in this year, okay, because it is accrued in the books, it is offered based on the approval in the last year itself. I would have offered to the tax in the last year because it is on the, when it comes to the ICDS, it says it's on the receipt basis. So this year I have to offer it to the tax. So that adjustment I have to carry out. And interest on compensation and enhanced compensation, this is particularly this is not dealt in the ICDS. So this will go by the provisions of the Act. When it goes to the provisions of the Act, section 145 clearly says that we have to go by the receipt basis. In the same way, we will be having the we have to do some adjustments as a reduction also. That is in case if there is a higher side income that has been reported in the financial due to the method that has been adopted, then we can take it as a reduction. And the interest on income tax if it is a vice versa case. So it is already offered to the tax, and but it is not received yet. It is only approval that happened in this year. Then we can keep it outside of the computation of the income. And when it comes to Indians also, this is the indicative list. We have given one thing is with respect to the revenue recognition. India says that it has to be the present value of the money that has to be recognized. So that is the one key thing here. And when it comes to the discount-funded securities and all, India's financial instruments, it says different treatment. Whereas when it comes to the ICDS, it says it has to be over the period of maturity. We have to recognize that the interest. So if you look at the what is the key differences between the ICDS, AS and the NDS. So it's when it comes to the revenue recognition, it's similar. The IAS and the ICDS, both are similar. And when it comes to the service transactions, ICDS says only the percentage of the completion method, and there are certain particular cases like the few contracts and all. But here the accounting standard gives two types of the methods. One is the completed contract method and the percentage of the completion method. And the SSE can choose anything. Okay, and in case of the percentage completion method, they have given a guidance whether it can be the stage of completion can be measured based on the cost or the output units. And when it goes to the Indians also, Indians when it goes to the revenue recognition, they said when the performance obligation has been met and the complete transfer of control over the goods or services has been taken place, that point of time only revenue can be recognized. So there also it says whether when it comes to services, it says it can be the based on the output method or the input method, that is the cost. So when it comes to the disclosures, in the sale of goods normally we recognize the entire revenue. So they said that in case if the any amount is or any revenue is not recognized because there is a lack of certainty on the ultimate collection, so that amount has to be disclosed in this as per the standard. And when it comes to the services, they said that the entire amount of the services that has been recognized as a revenue that has to be disclosed here. And in case if there is any inventory of the service, like unbilled revenue at the end of the year, and it's not, which is not billed. So in those cases, that amount has to be disclosed here, and the other disclosure that has to be given if there is the service is a work in progress. What are the costs incurred and what are the profits that has been recognized among that unbilled revenue, and in case of any advance that has been received from the party, that advance details we have to disclose, and amount of the redemptions. So last two disclosures similar to the ICDS 3. In the case of construction contracts also, we have to disclose those things. So far, any questions?
Interest part, you mentioned that there should be reasonable certainty of ultimate collection, and if interest is approved on time proportion basis, interest is recognized as revenue, but after 2-3 years we never receive that interest itself. How do we tax it?
See, anyways, based on the time proportion basis, I would have offered to the tax. Okay, after 3 years down, I got to know that the vendor has insolvency or whatever the reasons. His working capital is very bad. So those reasons he is not able to pay so much of interest, or he may pay the portion of the interest. So those cases, whatever the interest we are not able to receive from the vendor, it can be written up in the books. Okay, so as I added, that can be taken as a deduction as per the 36(1).
It's not provided in ICDS, but Act.
Act gives. The next one is the ICDS 5 annual fixed assets. So it's mainly deals with the the fixed assets, like how it has to be capitalized and how the cost has to be measured about. So it deals with the tangible fixed assets. Intangible assets are not covered here, and there is a separate standard for that which has been not notified yet. So it deals with the main tangible assets like land, building, machinery, furniture. Okay, so which are used in the normal course of business to produce the goods or for the rendition of the services. Since the intangible assets are not covered in this standard, so how to treat those intangible assets? It will again go back to the Act, provisions of the Act, and the judicial precedent guidance that has been given. So here, what should be the cost of the assets? In case if it is a purchase, the assets has been purchased, then it will be the purchase price and the duties and taxes. In case if the duties and taxes like the GST and all, we can take input tax credit later on. So those to that extent we have to reduce the duties and taxes. And if any expenses that has been incurred, like a logistic expenses to bring to the asset to the location where it is intended to use, so those logistic costs can be included in the cost of the asset. And if there is any discounts that has been given by the supplier, discounts and all, that has to be reduced from the cost of the asset. And generally, what components that will be entailed for the capitalization. So, like the servicing equipments or the fire equipments, and if there is any machinery space, the use is irregular, it's not very frequent. So those has to be capitalized. And whatever the expenses that incurred initially, to if it is a plant, to construct a plant, if there are any drawings that has to be incurred expenses in connection with starting construction of the plant and all, those also can be included in the cost of the asset. And in case the asset has been purchased later on, we have done some improvements. Okay, so because of that, the efficiency of the asset has been increased. So that case, that improvement cost or repairs, whatever has been done, can be capitalized to the cost of the asset. And what should not be included in the cost of the asset? The administration and general overhead and the selling overheads, because those are not related to the acquiring the asset. And if any government grants, if anything I receive for acquiring that particular asset and all, then the government grants has to be reduced from the cost of the asset, and the net amount value has to be recognized. Yeah, so certain cases always the consideration will not be in cash. It will be like an exchange of the assets also. So those cases, what should be the cost? The fair value of the asset, tangible asset that has been acquired. So we have to do the valuation. What is the fair value of the asset, and accordingly we can take that as a cost of the asset. And suppose if I purchase a pool of assets for one price, so how I can divide that cost? Okay, so it has to be based on some fair basis. Like maybe again I have to do the valuation and understand what is the value of each asset. Then accordingly I can distribute based on the valuation what is the cost of each asset. And if the asset is held jointly by the others are also owners on that asset. So those cases it's like proportionate. What is my ownership percentage? It is 50% or 40%, whatever. Based on that, I have to recognize the cost or the return value for into the books. And in case if the later on many additions happens to that asset, if we can identify that addition as a separate asset, then we can recognize it as a separate asset. If it is a part and parcel of the, if we are not able to identify that asset, but if it is going to increase the efficiency of the existing asset itself, then we have to add it to the cost of the existing asset itself. And if we look at what are the key differences between the ICDS and the accounting standard. So one thing is the materiality that you are discussing. That is one of the key difference when it comes to the AS. It is not a material, the value of the asset. It can be always written off to the P&L when it comes to the ICDS, because it doesn't recognize the concept of the materiality. So that is one of the key difference when it comes to the ICDS and the accounting standards. And in case if there is a transfer of the asset, so if the asset has been sold, so the standard told it has to be dealt as per the process of the Act. So basically, if there is a transfer of the asset, in case of the block, we'll go with the block of assets when it comes to the income tax. If the block is getting erased completely, then whatever the value, the negative value, will be operated to the capital gains. So if it is not, if the block is not getting erased, and if there is a still there is a closing return value, then we'll be taking the depreciation of that, the balance amount.
Yeah, how do you account for replacement of assets? Like some parts, if you are replacing in a machine or something, you are discarding the old part and replacing it with a new part. In that case, the block still exists.
Yeah, in that case, if if I am replacing the part, suppose if the asset is today is operating at a capacity of 1 lakh units. Okay, by discarding that part, okay, the efficiency of the asset has been increased. So it is giving me the unit like a 120 units or 130. So the efficiency has been increased. Whatever the cost of that replacement has been carried out will be capitalized to the cost of the asset. The year that replacement has happened, basically we will add it to the cost of the asset as an addition.
And what if it just increases the lifespan of the asset and not the capacity as a whole?
Sorry.
What if the spare part that we have replaced, it increases, it's a normal spare part, but it increases the lifespan of the asset and the production capacity remains the same?
In that case also, because ultimately I am getting so if it is the asset if I will be using for the 5 years, it's again only 5 lakh units I will be able to produce it. If the lifespan is increased to the again 8 years or whatever, automatically the production is getting increased in a way. So that in that case also we can capitalize to the cost of the asset. So when it comes to the disclosure ICDS 5, it's when we put the clause 18 of the form 3CD, it's just a replica. So what has been described in the standard, it's like what is the block of the assets, with the description, there is a plant and machinery or furniture or the computers, so that we have to disclose. And what is the rate of depreciation and the cost or the return value as the case may be, in case if there is an addition that has been made, so that additions we have to disclose. And if there is any adjustment to the like corporate branch principles, or if there is any if there is a asset is imported from outside India, if there is any change in the fluctuation exchange rates when the settlement happened, so those impact also has to be disclosed. And what is the depreciation will be claiming as per the Act, and what is the closing return value. So this is similar to the clause 18 disclosure, the tax audit. So yeah, this is what the clause 18 also. And this there was changes that has been made to the clause 18 because of the 115BA introduction, where addition depreciation is not allowed. So those that is the additional thing that has been added in the clause 18. Yeah, the next standard is the ICDS 6 with the effect of changes in the foreign exchange rates. So if we look at the scope of the standard, so it mainly covers the 3 categories. So one is the transactions that has been taken place that has taken taking place in the foreign currency, whether it is a buy or sale of the goods or a borrowing, anything. So, and other thing is about the operations that has been carried outside India, whether if we have a branch or PE outside India, presence outside India, and we are doing the sale from that presence and all. And the other thing is with respect to the forward exchange contracts. So if we enter into any forward exchange contract with respect to the exchange currencies, so those forward exchange contracts also has been done in this standard. And when what is the when it has to be recognized and how the exchange differences has to be recognized. So the standard says it has to be on the date of transaction and what should be the exchange rate. Whether it's on the particular date or it says that it can be an average of the week or a month, the exchange rates that has been there. In case if there is a frequent fluctuation, the fluctuation is very high, and if the exchange rates are changing significantly, in that case it has, the standard rate has to be on the date of the transaction. So when it comes to like year end, we always, if there is any transactions or the asset in the foreign that has been purchased in the foreign currency, we will always reinstate based on the exchange rates that are prevailing at the end of the year. So when it comes to the monetary items, it says, so whatever the reinstatement that happens with respect to the monetary items, so there is a loss or gain that has to be, if it is a loss, that can be claimed as a reduction. If it is a gain, that has to be offered to the tax. When it comes to the non-monetary items, the standard says the loss or gain with respect to the non-monetary reinstatement of the non-monetary items cannot be taken as a deduction or are not able to be offered to the tax until the year of the section. And in case of the non-monetary items, if there is an inventory, suppose if the inventory is valued at the net realizable value, so then we have to take the exchange rate based on the date on which the valuation was carried out. So we have given an example here. So if you look at the trade receivables X, so their exchange rate on the date of transaction is 65. But some cases, we, due to some reasons, we are not able to get the exchange rate. Okay, of that particular, or it's not there was some recession in the country or not, exchange rates cannot be realized. We have to then look at it, what is the possible realization that can happen, what is the possible realization exchange rate. So that has to be considered for the reinstatement purposes. And if there is a otherwise, it will be go by the closing date when it comes to the monetary items, and when it comes to the non-monetary items, it will go by the date of the transaction. Yeah, the other thing that was covered in the standard is the foreign operations.
Here exchange rate means SBI by.
So for that, what exchange rate, whether it is a SBI, TD by rate or selling rate, what has to be taken, that has not been provided in the standard. So we have to go by the purpose of the act. So wherein it is a rule 115 or if it is a 43A, if there is a capitalism that has been imported outside India. So we have to see what is the transaction, and accordingly we have to see if it is a rule 115, it's most of the cases it says TD by rate, SBI TD by rate. So that we can take into the consideration. And foreign operations, this mainly if you have a branch outside India. So how we have to do the conversion of the currencies into the Indian currency, Indian rupees. So the standard says that operations has to be treated as if it's your own entity in India. And like how what standard told for the monetary items and non-monetary items in the previous slide what we discussed, based on that it has to be converted to the Indian currency, and what is the loss or gain on that, but the monetary items can be taken as a reduction, non-monetary we have to, it cannot be claimed as a reduction. And the forward exchange contract, so this is the other aspect that has been covered in this standard. So here if there is any when we agree for the forward exchange contract with respect to certain currencies that we are going to exchange in the future. So what is the date, what is the rate at the date of inception, and what is the forward date that I am agreeing with the contract. If there is any difference, obviously there will be some difference. So that whether there is a premium or discount that can be recognized as an expense or an income at the end of the year. And there is any renewal or cancellation of the forward contract in between the year, so then the expense or the income arises on account of that can be recognized, can be taken as a reduction of to the tax. And when it comes to the market losses, that is or the year end when I'm reinstating the forward to exchange contracts. So whatever the loss that there is can be taken as a deduction, because if you remember the ICDS one says mark to market losses or expected loss cannot be taken as a deduction unless the other ICDS allows. So here when it comes to the forward exchange contracts, so ICDS allows if there is any loss or gain, if there is a loss then can be taken as a deduction, or gain has to be offered to the tax. So but here there are certain exceptions in the standard. In case if the forward exchange contract is mainly for trading or speculation purposes, or if it is to hedge the foreign currency. So those cases, they have given an exception. They said that you have to wait till the year of settlement so to claim it as a deduction. It cannot be claimed as a deduction or offered to tax in the year on account of the reinstatement. Even the same thing it will apply to the mark-to-market losses also at the year end. If there is any reinstatement with respect to this set of contracts, then that same cannot be taken as a deduction on account of the reinstatement. That can be taken only deduction in the year of the settlement. And here, if you look at what are the key differences with respect to the effects of changes in the foreign exchange rates. So here, when it comes to the ICDS, when it comes to monetary items, it does not differentiate between the integrated operations and non-integrated operations. Whereas AS, it's clearly it gives one type of treatment if it is an integrated operations. If it is a non-integral operations, then it says it has to be given the equity by way of foreign currency translation and so on. So that is one difference is that when it comes to the monetary items, because integrated operations are that where the branch is completely dependent on the head office. So those cases we call it as an integral operations. Non-integral operations are that where the branch is operating as an independent. Like if it is a sale of goods or something is carried out, it will take the inventory from the head office, and it will also third party's inventory also maybe it will be selling. So it's not entirely dependent on the head office. So those cases we call it as a non-integral operations. So here even if there is a monetary item for the non-integral operations, it says that the impact cannot be given to the P&L. It has to be given to the equity when it comes to the AS. And even in the case of long-term monetary items, it says that whatever the impact, the exchange fluctuation it will be there, that has to be recognized over a period of that period. It cannot be recognized immediately as an expense of deduction. So these are the two differences, key differences when it between the AS and the ICDS. And the Ind AS is whatever exchange gain or loss it says, it can take as a profit or loss unless it is otherwise notified in the. And here, when it comes to the effects of changes in the foreign exchange, there are no disclosures that has been followed in the standards. So there is no requirement to give any disclosures as per this standard. So the next standard is the government contracts, government grants. Here, if we look at the Act, the Finance Act has made an amendment in the Finance Act 2015 has made an amendment in the Act, wherein in the section 224 that talks about the income definition. So they said that if any government grants or any assistance that will be received from the government will be should be offered to the tax in the year of receipt itself. Okay. So still after that amendment is carried, even if the amendment is carried, still they have modified this standard because there is no guidance in the Act like what is the timing of how the capitalization has been dealt. If the grant is for a particular asset, how it has to be dealt. In case if the conditions attached to the grant has not been fulfilled at a later date, if there is a refund of the grant, then how it has to be dealt. So all these things are not, there is no guidance in the Act, so this standard has been notified. And it mainly deals with the all types of the government grants, which are mainly in the nature of duty drawbacks, subsidies, or if any reimbursements or the concessions that government gives. And it excludes the certain types of the assistance and the grants. So if there is any assistance, suppose there is a competitor to you, the government imposing some restrictions on the competitor. So it's a kind of an assistance it is giving it. There is no grant that has been given. So that is not covered in the standard. And if there is a government stake in the enterprise, how it has to be dealt, is it a grant or so those things are not dealt in the standard. And other thing when it comes to the government grants, if there is any grant that has been given by the government, and if you are not able to determine the quantum of the grant, suppose if there is a debt that has been given at a free of cost, interest there is no interest on it. So even if we adopt some rates based on the bank rates or something, it will be like a notional interest. It is not an actual interest. Maybe government would have charged some other interest rate. So it's very those cases it will be difficult to quantify what is the benefit of it. So those kind of government grants also excluded from the ambit of ICDS 7. And when it comes to the ICDS, say when the grant can be recognized and offered to the tax. So it says that there should be a reasonable assurance that the conditions attached to the grant will be fulfilled, and there should be the collection, like the receipt. There should be a reasonable certainty to the extent of that the collection also. And it has put the one more condition. It says the ICDS says that the recognition of the grant should not be beyond the date of receipt. So it's like it should be with the date of receipt of the money from the government. So it's like it will be like the conditions fulfilled or the receipt, whichever is earlier. And if you there are certain special cases that that the ICDS has called out under what type of treatment has to be given. In case if the grant is for like a depreciable assets, for a specific asset, the grant has been given. So in that case, that particular grant has to be reduced from the cost of the asset. In case if the asset is recognized in that year itself. In case if the asset is already there in the block of assets, and then we have to reduce this particular amount from the block of assets. And in case if the grant is for the non-depreciable assets, so what is the treatment? So in that case, the grant, whatever has been given, has to be recognized over a period of time in proportion to the cost that has been incurred with respect to the asset. And if it is grant is given for a pool of assets, it's not only for the specific asset. Like then only the one asset has been recognized in the that particular year. So how it has to be determined? We said that the proportion of the asset out of that, then the grant is for 100 crores. The assets, if there are 10 assets, value of 120 crores. Okay, one asset value is like 20 crores. They said that the proportionate grant, like 20 by 120, like 1/6, has to be recognized, taken into consideration. If it is a depreciable asset, that part of grant has to be reduced from the cost of the asset.
Yeah, in case of fixed assets grant on receipt basis, we have to do it. Adjustment against the fixed asset should be done on the receipt basis.
In the block of assets. Yeah. So suppose if you already fulfill the conditions before the receipt is done, then you can do it in the year itself. Okay. It need not to be on the receipt basis.
But we have fulfilled the conditions, but receipts of grant is not happened in that financial.
It not happened, but there is a certainty that definitely it's going to come. Okay, and then in that case you can take it in the year itself, even though the receipt doesn't take place. The other thing is like suppose if any compensation or if any expenses that have been incurred on certain CSR activity or some other things where the government wanted to give the reimbursement of those expenses. So in those cases it has been called out in the standard. It's like the year in which it is receivable. So when I fulfill all the conditions, then the grant has to be done. So the year in which it is fulfilled has to be offered to the tax. So here if you look at one thing. Like if you look at the section 41, okay, where it says if there is any expenditure that has been claimed as a deduction or allowance that has been taken as a deduction, and later on if you are receiving any amount, like if it is a creditor written off, okay, that has been done. So later on if you are going to recover the amount from that creditor, so that has to be offered to the tax in the year in which that amount has been received as per the section 41. So here if you look at here a similar thing, I am incurring the expenditure. Later on, the government is giving the benefits to me. So they're compensating me. So and as per the standard, it says the year in which it is receivable. But in the 41, it says on the receipt basis. So there is a conflict between the 41 and the ICDS. So here we can because always the Act prevails over the ICDS. So we can go by the 41 and we can recognize or offer to the tax in the year of receipt. In case of any non-monetary asset, if there is any concession or waiver that has been given, so whatever the value, whatever the price that I paid, so that has to be recognized as the cost of the asset. And here, if you look at when it comes to the asset, suppose the grant has been received in the year 1, but I have not purchased any asset. I will be purchasing asset in the year 2. In those scenarios, how it will work? So, because if I look at in the year 1, even though I received the grant, I don't know the cost that I am incurring for the asset. So thereby the mechanism gets failed. So those scenarios I can go to the year 2 when the asset has been purchased and then can offer to the tax. And in case of refund of the government grants, so suppose if the conditions that are attached to it have not fulfilled completely, so then they may have to refund the money back to the government. So those cases, what is the treatment that has to be done? So in case if there is any unamortized, like the amount that has not offered to the tax, there is the portion of that amount, then first I have to adjust against the unamortized amount. If there is any balance amount is there, in case of a depreciable assets, then I have to inflate the cost of the asset, because when the grant has come, that time I have reduced the cost of the asset. So since now I am refunding back the money to the government, then I have to increase the cost price of the asset. Yeah, so here again, say the accrual thing again it comes to the picture here. So suppose I receive we are discussing about the asset, like I received the grant in the year 1, whereas I have not done I have not purchased the asset. Or I have not, it can make a scenario where I have not fulfilled the condition set, only the grant has been received in advance. So those cases, the standard says I cannot postpone the recognition beyond the date of the asset, but the condition attached to it have not been fulfilled yet. So how can how the income has been accrued in that case? So to the extent it is contrary to the purpose of the Act. So thereby they have made an amendment in the Act, the section 145B, wherein they said that it has to be recognized in the year in which it is received, in case it is not offered to tax in the earlier years. Like if the conditions have been fulfilled in the earlier years, then I would offer to tax in the year itself. Thereby the receipt will fall later. So whereas the receipt is before the fulfilling the conditions, then there is a contrary to that, because I have not fulfilled the conditions. How can I recognize the? So here also again we can take the section 5 straight under the section 5, and this is a view that we can take that since the conditions are not fulfilled, the revenue is not being accrued yet. Then it's going to be a notional revenue kind of a thing, because I have not fulfilled the conditions itself. So we can take that view and we can offer to the year in which the conditions have been fulfilled. If you look at the conditions, if you look at the differences between the ICDS and the accounting standards, so one major difference is that it says it cannot be beyond the date of the recognition of the grant, whereas the accounting standards there is no such conditions. It says only after I fulfill the conditions, then only I can recognize the revenue, even the grant has been received prior to the fulfillment of the conditions. And the Indians is similar to the IDA. So there is a key difference between the ICDS and the EAS. And when it comes to the disclosures, it mainly says if there is any grant has been received, what is the nature of the grant, and if it is related to depreciable assets or non-depreciable assets, that how much was recognized in the books or reduced from the cost of the asset. If it is pertaining to the other grants which are not related to the assets at all, so those cases how much revenue has been recognized and what is the nature. In case it is not recognized due to some reasons like what we discussed, non-fulfillment of the conditions, or if the mechanism fails, I don't know what is the cost of the asset. So those cases, if there are any such peculiar cases, that has to be clearly discussed with the disclosure has to be made as per this standard. So this is our indicative disclosure. In case if we don't have any grants, this is not applicable only. And if you have any grants, then we will make this disclosure. So next one is the securities. So when it comes to the securities, so because when you look at the ICDS, the construct, it is only applicable only the two heads of the income, one is the PGP and the IFRS. So securities, we always say there will be two possibilities. One, it could be capital assets and the stock in trade. If it is a trader or a speculator who continuously deals in the security, then it will be a stock in trade. So since the standard is applicable only to the business income, capital gains is not applicable. So that's the reason in this scope of the standard also, they clearly told that, mentioned in the standard that it will be applicable only to the securities that has been held as a stock in trade by the broker or any other person who regularly deals in the securities and who offers income to the tax as a business income. And here there is another part also that is for the regulated institutions like the banks or scheduled banks and the public financial institutions. So this standard has been divided into two parts, and Part A and Part B. So if you look at the Part A, so this standard is not made applicable to the again regulated companies like insurance sector and all, and the mutual funds and venture capital non-scheduled banks also is not covered. This only scheduled banks has been covered in the Part B. And when it comes to the FIIs, foreign institutional investors, if there is any security that has been held, even it as a stock in trade, the section 214 clearly says that it has to be capital assets only. It cannot be as a stock in trade, so that is also not covered. And one important thing, this standard doesn't provide a guidance like what has to be stock in trade and what has to be the capital asset. So that guidance we have to, for that guidance we have to rely on the circulars that has been issued in the past. When it comes to the security, what is the security? So here it's the definition of security is similar to the definition that is provided in the SCRA, that is the Security Contracts and Regulations Act. And the other thing that has been added is the share of the company in which the public is not sufficient, that is the private company shares. And one important thing here, this party doesn't include the derivatives, the options or futures. Those securities are not covered here, even if it is considered, even if it is dealt as a stock in trade. And when it comes to the part B, that is the banks or the financial institution, the security definition covers the derivatives as well. So since the derivative instruments are not covered here, if you look at the ICDS, whereas the forward exchange contracts are covered, that is one of the kind of the derivative instrument. Whatever the other futures and options, how we have to do it, then again we have to go back to the ICDS one, because that's where we have to follow the principles that has been instituted in the ICDS. So when it comes to the recognition, how the security has to be recognized, what should be the cost of the asset? It's like the actual price that has been paid. If there is any charges, brokerage charges, or the fees that has been incurred with the asset, that security that has to be that can be taken as a cost of the asset. When it comes to the STD, there is a separate deduction that has been provided in the Act. So that's the reason that STD thing we cannot include it in the cost of the asset. And in case if there is any unpaid interest that has been included in the cost of the asset, later on if it is recovered. So whatever the interest that is there till the date of acquisition of the asset, that has to be reduced from the cost of the asset, and the balance interest has to be offered to the tax as an income separately. And in case if the stock in trade has been converted into capital asset, so in that case the conversion, what is the treatment? Like whatever the fair value that is on the date of conversion has to be considered for determining the cost of the capital asset. And if there is any difference, if it is the other way around, like the capital asset is converted into the stock in trade, then we have to determine the fair value of on the date of the valuation, on the date of the conversion, and whatever the difference is there, cost of the capital asset and the fair value, that will be offered to the tax as a capital gains, and the cost of the stock in trade will be the fair value on the date of the conversion. And what is here also again the inventory thing will comes out. So how we have to measure the inventory in case of the securities? Is that it has to be based over the cost of NRV, similar to the ICDS 2. And in case, and here also there will be a guidance in case we are not able to identify the cost on a specific basis. Then they said that we can follow the FIFO or weighted average cost method to determine the cost of the securities. And unlike the AS, here they said that when it comes to the NRV, how we can determine the NRV, they have categorized, they have given the categories like shares, we can categorize into one bucket, and debt securities can be categorized into different. So we have to go by the category wise and determine the NRV, not on the each security wise. And in case of the securities, there is a listed securities and if it is not listed as of the end of the year, or if it is not a listed securities, they said that it has to be the actual cost. We cannot, there is no option of NRV here, it has to be the actual cost. And in case if there is any, when we recognize the NRV, if there is any difference between the cost and NRV, so that loss, they said that it can be taken as a deduction as per the section 36(1) clause 13. And if there is any gain, that has to be offered to the tax. So this is the example that we have given. So on the consolidated basis, if you look at the individual basis, the NRV is 505, whereas if you look at the consolidated basis, it's a 535. The similar way as the debt security also. When it comes to the part B, it said that because it's a regulated institution, so like banks or the public financial institutions, they said that you have to go with the RBI circulars and the guidelines when it comes to those things. And they have not clearly told how it has to be recognized and how it has to be offered to the tax. So when it comes to the differences, the key difference here in the ICDS is clearly used the cost measurement. They have given option before weighted average cost method. In the accounting standard, that guidance was not there. Okay, and in the accounting standard, in the ICDS, they said it has to be category wise. Whereas in the accounting standard, they have an option either it can be individual or the category wise. India is slightly different. It's the financial instruments, whether it has to be, how it has been recognized in the books, whether it is an amortized cost or fair value. Based on that, we have to give the claim. And there is no disclosure that has been described in this standard as well. The next one is ICDS 9, the borrowing cost. It's mainly about the what is the timing of the recognition of the borrowing cost and when it has to be capitalized. So it doesn't cover the if there is any preferential capital equity, what is the imputed cost. It doesn't deal with the imputed cost. So when it comes to the borrowing cost, it says that if any related to the particular acquisition of the asset or construction of the asset, that has to be added to the cost of the asset. In case of the general borrowings, then there is a formula that has been given in the ICDS. Accordingly, it has to be capitalized. So, and here they said that it has to be qualifying asset. What is qualifying asset? They said that it's land, buildings, furniture, and even in intangible assets also covered here. And inventories that will take 12 months of the time period. So those inventories are covered in the qualifying asset definition. So what should be the commencement or cessation of the capitalization? Like what period I have taken into consideration? If it is a specific borrowing, if it is for the acquisition of a particular asset, then it should be from the date on which the borrowing was made till the date of asset put to use. The interest whatever is accrued, that has to be added to the cost of the asset. If it is a general borrowing, it has to be from the date on which the funds are utilized, not from the date on which the funds borrowed, and until the asset was put to use. So, and in the general borrowings, they are given a formula. It's like total cost I have to take. The numerator will be the total value, average cost of the qualifying assets. Denominator will be the total value of the assets. If there is any specific borrowings included, that assets we have to keep it outside the ambit. The same thing works for the interest also. And yeah, so the key difference here is that mainly here they clearly told if it is specific borrowings or general borrowings, what has to be the treatment and all. When the accounting standard says what has to, when it has to be the application has to be commenced, only that has to be prescribed. And the accounting standard also clearly says that, but there is no guidance like how to determine the cost in case of the general borrowings and all. So yeah, when it comes to the disclosures, what is the policy that has been adopted for the borrowing cost and the amount of the borrowing cost that has been capitalized. Here we need not give the asset category wise. We can put as a one amount, whatever the interest that has been capitalized. So maybe we can maintain that as a backup bookings. In case if the tomorrow tax officers ask, we can give that asset classification of how much interest has been capitalized. I think considering the time. In case if there is any dissolvence, suppose if there is no TDS has been done, or if there is a 49 dissolvence, okay, and if it is a 43B, if it is not paid, then we will dissolve it. If it is to the scheduled banks and all. Those cases, the dissolvence part, we have to keep it outside because section says it has to be disallowed. So the Act prevails over this ICDS. That's the reason we keep that component of interest outside this capitalization. The last standard is about the provisions and contingent liabilities and contingent assets. So I'll directly get into the provision thing. So here when the provision has to be recognized. So there has to be a present obligation out of the past events. Okay, and it should be a reasonable certainty. When you look at the AS, it says probable certainty. Probable means it's a more likely than not. It's like a 50% whether it can happen or not happen. It's a 50% success rate. Here it says reasonable certainty. It is more than the probability. It's like above 50%. So that certainty should be there that there will be outflow of the resources and all. And we can estimate what is the provision that I have to make. There should be a best estimate with in case of the warranties or sales data and all. We always see the past data and based on that we'll make a best estimate. So that's what the standard says, and it clearly says that you should not make any provision for the expenses or anything that is related to the future business operations. It should be always about the past events. It cannot be related to the future events and all. In case if there is any enactment or there is a draft amendment that has come into the that has been released, but it is not yet enacted in the Act. So we have to make that provision in the year in which the law has been enacted. It cannot be at the draft stage. And the provision for the employee benefits that is also not been dealt in the Act. This ICDS 10 that has to be go by the provisions of the Act. That what will be. And yeah, the provision has to be at the best estimate. What is the best estimate? It depends on the nature of the provision. What is to be made. And in case and we have to review the provisions at the end of each year. If the provision is not required, then we have to reverse that provision and we have to offer to the tax in case it is claimed as a deduction. And when it comes to the contingent liabilities, it's like we know that this obligation is going to come, but it depends on the occurrence or the non-occurrence of the events. Like I don't have a control over the events. So whether it may happen or it may not happen. Based on that only, whether the liability will arise. Or in the other case, it will be like there is an obligation that has been erased, but there is no reasonable certainty that the money, that settlement has to be done. Or I am not able to measure that particular thing. In those cases, it has to be contingent liability. And anyways, contingent liability it cannot be recognized in the books and it cannot be even be claimed as a deduction. The same thing applicable for the contingent assets also. The definition is same. Only here it's when it comes to the asset, it will be the inflow of the resources. It's not the outflow, and it can be recognized as a the income in the year in which that reasonable certainty arises. It shouldn't be based on the events that are not based on occurrence of the events that are not in the control of the company, and it has to be it cannot be at a discounted value. So this is the disclosure that has to be made when it comes to the provisions of the contingent liabilities. Basically, it's about the provision opening value. If there is any additions, if there is any inflation, that if any provision has been converted to the expense, and if there is any reversal, if there are any new provisions that will be added to the list, and in case if there is any reimbursement that we are expecting, so that to that extent, that also we have to make a disclosure. The same thing is applicable to the contingent assets and the income part. And this is our indicative disclosure. So we have given a few cases, scenarios, like our warranties of the GST, other expenses. So this is the disclosure that has to be made. And maybe the contingent assets also, what is the opening balance and closing balance, and if there is any reversal with respect to the provision, if there is any additions, that also has to be disclosed. And here the difference when it comes to the ICDS and accounting standard. ICDS is it's a reasonable certainty, but whereas standard accounting standard says it's a probable. So that is the difference, key difference when it comes to the provision. And when it comes to the recognition, like what is the base, how it has to be recognized and all. So both the standards says it has to be at the best estimate. And contingent asset, it's more like similar, only it says the ICDS it's in the year in when there is a reasonable certainty, where here it says it's virtually certain. So this is the key differences when it comes to the ICDS and the accounting standards. In AS it says the provision is material, then it has to be at the discounted value, the present value of the provision that has to be recognized in the books. So that is the difference, the key difference when it comes to the NDS. That's all. If you have any questions.
Said that Delhi High Court judgment in the Chamber of Tax Consultants have pushed many provisions of the ICDS into the handbook.
Because the judgment has been given that this ICDS is unconstitutional. So to negate that judgment, so they made the amendment act. If you look at recently, there have been so many amendments that has been carried out in the act to negate the judgments. Even the PF thing, I know Supreme Court has held in favor of the review. Of course, but if you look at the Finance Act, they made amendment act to negate the judgments and even the education says for that matter. So because whenever there is their intent is different, the authorities' intent is different, and then there is a intent showing, they're trying to make the amendments in the act so that they can negate the judgment.
Just once more tell me about the M2M losses and profits. Should be ignored or considered?
Yeah, so when it comes to, there are two things. If it is a forward contract, there is one set of contracts. If it is forward contract, is not for the trading or speculation. Okay, and if it is not for hedging for the foreign currency. Okay, if it is like other way, if it is other set of contracts, if it is not for those cases, they said that market losses can be claimed as a deduction when you reinstate. Okay, if it is for the trading or speculation, that forward contracts, or if it is for the hedging of the foreign currency, then in the year of settlement only you can take it as a deduction.
Like stock markets and all like.
Stock markets when it comes to, because it says stock in trade. This standard is only applicable for the stock in trade, not for the capital assets.
So we have to consider.
Yes, we have to consider in the stock in trade. When you have
profit, unrealized profit and unrealized loss has to be considered in the financial year for accounting purposes.
Yes, it's the standard. That whatever market loss, if there is any reinstatement, like, because at the end of the year, I have to determine the value of the stock, because based on the cost or NRV, whichever is lower. So if I regulated cost, in the end of year, I have to reinstate to the NRV, okay, because NRV is lower compared to the cost. Then there will be a difference that is going to occur. Okay, so they said that the difference can be claimed as reduction because I am treating the securities as a stock in trade.
What about the profits also?
Gains of the same.
It's higher value.
That's what because when you are taking the deduction and whether the loss, the same logic will apply to the gain main purpose.
On behalf of ICA Bangalore branch, CA Srinivasa Tikkisetty, thank you for the wonderful session. I request our chairman, CA Pramodar Hegde, to present a moment to the speaker as a token of gratitude. I thank all the participants for their wonderful participation and staying till the end. Thank you.